Before addressing your question, I'd like to touch on those two topics of valuation and price appreciation. It's important that we don't view equity valuations in a vacuum based on historical standards today. I think it's important that we look at them relative to prior peaks like 2007, where balance sheets were a lot more levered, both household and corporate. Today, household and corporate balance sheets are in much better shape. We also need to compare equity valuations to the other options that investors have when investing in the U.S. For example, core fixed income and investment-grade corporate debt. If you applied a multiple to those investment asset classes, they would appear much more frothy than equities on a going-forward basis. So on a relative basis and on a risk-reward basis, equities appear very compelling based on other investment opportunities to investors. First and foremost, investors should not lose sight of the goal of the fund, which is to provide a consistent payout. If we think that equity markets are going to rise continually, but at a slower pace, you would expect this fund to provide upside participation while also providing that consistent payout. If equity markets are to decline, you would expect this fund to provide dampened downside volatility. With a beta of 0.75 and a couple percent less in standard deviation volatility, this fund should provide a dampened downside protection in the event equity markets decline. If core fixed income enters a period of decline, you would expect this fund to offer relative outperformance and diversification benefits due to its investments in high-yield bonds and convertible bonds, which offer relative outperformance and a very attractive risk-reward compared to core fixed income. In conclusion, the fund should offer dampened downside protection versus pure equity and relative outperformance versus core fixed income while providing dampened downside volatility and a consistent payout on a going-forward basis. So when we think about the income and growth fund, what we try not to do is focus so much on the payout, the dividend yield or payout of that 9%. What the fund is designed to do is provide that 7.5 cents per share per month payout. The fund has the benefit of providing this distribution because it's able to leverage the 7 sources of income, including capital gains, coupons from high-yield bonds, dividends from equities, and option premium from covered call strategy. Regardless of the market environment, the fund is able to provide that consistent income. Even if markets are falling, issuers of high-yield bonds and convertible bonds, as well as issuers that pay a dividend, will continue to pay those, regardless of whether the market is moving up or down. These income streams remain consistent. Lastly, covered call options provide an additional source of income to help supplement the distribution on a going-forward basis. So in periods of rising volatility, the implied volatilities of the individual portfolio holdings offer the team a chance to be tactical and write option premiums at attractive annualized yields. Furthermore, during certain periods, the investment team is able to realize capital gains which do not correspond or exceed the corresponding period for distribution. Those accumulated gains can be used to smooth out and provide a steady distribution on a going-forward basis. So an example of these diversification benefits when I think about convertible bonds and high-yield bonds versus core fixed income is the period that we experienced in the beginning of 2015. At the end of January, on the 31st of the month, the 10-year Treasury had an interest rate or yield of 1.68%. It rose consistently over the next 3 months into early May to about 2.3%. The price return during that time frame was negative 3.9%. Conversely, convertible bonds rose 4.9% and high-yield bonds rose 2.9%. So here is a prime example of the diversification benefits and relative outperformance that these non-traditional fixed income classes provide relative to core fixed income. So I'll address 2008, and we can always look back on the US-based fund as an example. The US-based strategy, which dates back to 2007, consistently paid 8.75 cents per share per month and has maintained that distribution on a going-forward basis ever since. So if we think back to the global financial crisis, what was key to this fund and successfully delivering that payout is holding high-quality, high-yield bonds and convertible bonds where the issuers continue to pay their coupon, as well as attractive equities where the dividend was stable and the investment team continued to receive those dividends on a quarterly basis. Although they were scarce on a going forward basis, We were able to supplement the distribution with previously earned capital gains earlier in the year. Secondarily, volatility spiked to 80, and that was a record in its own right. However, implied volatilities in the portfolio exceeded that amount by a greater degree. So with a height in volatility, the team was able to take advantage and be opportunistic and tactically allocate using the covered call strategy on equity holdings to help supplement that income. With regard to the fourth quarter of 2014, what I'd like to do is first address the performance of energy. So the portfolio within the three sleeves was underweight energy across high yield bonds, equities, and convertible bonds. So the primary weakness in the market within those three different asset classes was high yield. As a matter of fact, convertible bonds and equities actually rose 1.9% and 4.8% respectively. In addition, it is important to note that each of the sleeves' performances outperformed on a relative basis compared to their universes. But to answer your question, the income from convertible bonds and high-yield bonds, as well as dividends from equities and capital gains realized during that period, were sufficient to meet the distribution throughout the fourth quarter. So there were no significant changes by the investment team during the 2008 crisis. What is most important is that our bottom-up approach steered us to the higher quality issuers in the convertible and high yield space. So by focusing on companies that were going to meet their debt obligations and continue to pay their dividends over time, the fund had a steady stream of income that it could rely on to meet that distribution on a going forward basis. In addition, and as I mentioned earlier, with the heightened volatility, the team was able to tactically and accurately write covered calls to generate additional income.